Goldman Sachs says the Federal Reserve will hold rates this year, defying market expectations for several cuts. The bank added Jerome Powell's warning the Fed will, quote, act as appropriate to sustain the expansion was not a strong hint of an upcoming cut. This is Jan Hatzius over at the economics team at Goldman Sachs here. What do you think of that call, Daniel?
I think it is likely that there will be one cut, but at the end of the year, at best, if the data of economic growth, industrial production is weakening, jobs number was at least challenging, the last one that we saw. So there could be a rate cut. I think that the market is probably too optimistic about 2 rate cuts, even about a possibility of a QE. I think that the Fed wants to keep tools in order to address a change in the economic cycle that could be more severe than expected.
So Dan, tactically, what do you do then? Because investors have been buying the market because they think there's going to be a Fed rate cut, whether it's July or September or maybe both. So does this mean the market buying is wrong at this point, or should be tactical out there and be going with the market rally?
Well, I think that you need to be in equity markets right now because the policy of central banks, not just the Federal Reserve, is going to continue to be extremely accommodative. You need to be as well.
You said one at best. So if the Fed doesn't move, then I can't see anyone else moving either.
I'm not entirely sure. You have small pieces of policy that change here and there. You've seen it with the ECB that apparently did nothing but ended up being a lot more dovish than what we initially expected. So there's little things here and there that central banks are doing to push risk asset prices further. At the same time, the fact that recession is not evident leads markets to be more complacent, as we talked about before. Earnings are not good, but they're not bad either. Therefore, you continue to have an incentive to be invested. What you have to be is probably out of the more cyclical part of the market and closer to those sectors that are less moved in terms of earnings by the economic cycle and more, for example, by rates and by liquidity. Companies that are more akin to sort of bonds, or companies that are closer to the defensive part. At the end of the day, of course, they are the most expensive, but they're expensive for a reason.